Hey everyone, Paul here, and in this video I want to walk through an example of what happens to your account if you sell a cash secured put. We can also kind of walk through what that means a little bit as well, but we're going to talk about what happens to your cash balance, what happens to the value of that premium, why it's actually going to show as a negative, all these different things. But let's say for the sake of argument that you're starting out with an account that has $13,500, okay, and you're trying to figure out how to get a return on that. And let's say that you also are interested in Meta for some reason, okay? It could be the fact that, they've got, 40 or $60 billion in cash, which works out to be somewhere in the neighborhood of like $20 a share. It could be the fact that their, PE ratio is down to 12 or 13, and they're potentially one of the most undervalued technology stocks out there right now, certainly in the large cap space. Could be those reasons, could be something else, whatever it is. Again, this is just illustrative for an example. Do your own due diligence before you just go blindly doing something you see online. But I'm going to use Meta as this example. So on September 20th, 2022, Meta actually closed. We can put that up here. Meta closed at 146.09. Okay. Now, one of the things that we could do, and we can, have different price points, but seeing as we have 13,500, and when we sell a cash secured put, we have to have each contract is 100 shares. So with the 13,500, we could say that we would buy Facebook, or Meta rather, at 13,500, which would be $135. So if we buy them at the 135, and again, it'd have to be the 100 shares, which is how we get to our 13,500. We can just, see, and that's not a value. We can see that that would leave about 8% room for the stock to decline before we would actually have to take ownership of Meta. So if we sell this put, that would say that, we would actually buy Meta at $135. Let's just say that we'll do it approximately 4 weeks from now. So let's just say we're going to sell Meta. I'm just going to write this out. 2022, the 135 put. So this is what it's going to look like in a lot of brokerage accounts. I'm specifically looking kind of at how it looks in Schwab, but you can, sell options in Robinhood and really all the major brokerages. It's just going to be slightly different about how their interface works. But this is kind of the jargon of it. Now, if we sell this, we're going to actually get, as of the close, we would have got $385 in premium. So let's make note of that. Premium, $385. What does that mean? That means if you sell a put, which is essentially this contract that in layman's terms is going to say, if Meta falls below 135 by 10/21, you have to buy them for $135, and you get paid $385 for that transaction. So what happens, if you get to 10/21 and Facebook or Meta, I'll get that right. What if they're above the 135? Well, you get to keep the full 385, no harm, no foul. If they're below, you have to buy it. You still keep that 385, but now you have to buy them at a higher price than the current market value would be. So again, let's just think about the steps of this and what's actually going to happen to the account, right? Because the main point of this is really walking through. You start out with 13,500. What happens from the time that you actually sell this to the time you potentially close it, by the time you buy it back? What's happening with the account? What's happening with the cash balance? So again, let's think about all these things. Another thing to keep in mind here actually is that the account balance and the cash balance, they're actually going to be the exact same thing before you do anything with your account. So now we're going to say that we actually sell the above puts, okay? So if we do that, now what is our new cash balance and what is our new account value? Well, the new cash balance, we know that we got paid $385. So all we do is we take our original cash and we're just going to add $385. So there we go. We got 13,885 in the account just like that. And while the cash truly does hit as soon as you sell it, one of the things you have to realize is that you have an obligation to now buy the stock if it falls below the level that you predetermined, in this case that 135. So because of that, somebody else owns an option that's worth that 385. I mean, if we really assume, for simplicity, that there was really no change to the stock price, if you wanted to buy this back, again, if you, without taking into account the bid and ask spread, which would potentially be a couple dollar difference, you could really buy that back as soon as you sold it for about the 385. So to account for that, there's actually going to be a line in your account that's going to be for a negative 385. And that's actually going to, so we're going to have that negative 385, and then it's going to add that to your cash. So immediately after you sell this hypothetical option for Meta, this 135 put for October, immediately you have an increase in your cash and no change to your account value. And really you can kind of think about this, there's a certain amount of equity that can be built up or lost based on the value of that option. And how does that work, right? Let's think about, so again, this is after selling put, okay? Let's think about a situation where Meta, got it right that time, the parent company of Facebook, Meta, the stock goes to, let's just say they rally to 175. Well, if the stock goes from 146 to 175, that makes it less likely that it's actually going to dip below 135, which means the premium would actually decrease. But again, remember, that's actually good in our case because this 385 is a negative in our account. It's a positive in whoever bought this option from us. So in that particular case, let's say the new premium is 150 bucks. Well, now what actually happens, right? So what's the difference between this 385 and this 150? 235. So after stock moves higher, and we're going to put a apostrophe there. So after the stock moves higher, we have a new cash balance to think about and a new account value to think about. Expand that. So our new cash balance is the same as our old cash balance. Still have the 13,885 because again, this hasn't actually expired yet. We're saying that this stock goes higher, let's say by October 7th. Let's just say that again. So it's before it's actually expired on 10/21. The stock is higher. There is a difference to the account value, as we were saying. So again, that 13,500 would actually be higher by the difference between that 385 that we got originally and the difference in the 150, which is that 235. So now, again, stock goes higher, didn't change our cash. It does change the account value. And really what this kind of means is that if the premium or this option is now at 150, this means that between that 10/7 or that date in the future, between that point in time and when the contract expires, this is all you actually have left that you can make. Let's even kind of make this more dramatic. Let's say that Meta would have actually, let's say Zuckerberg decides that he resigns and everybody is thrilled by that news because apparently he's not that favorable of an executive these days. Let's say the stock goes to 250 bucks on the news of Mark Zuckerberg handing it in, deciding it's he's got enough money, leadership isn't for him anymore. The stock's at 250. Well, what's the new premium in that case? Again, now all of a sudden we have to say, what are the odds that it's going to go from 250 to 135 within 2 weeks? Probably pretty low. In fact, we'll say that the new premium in that case would only be 10 bucks. Well, now what happened? Now, if we look over here, our cash balance and our account value are only off by $10. And only off by $10 because if we wanted to buy that contract back, we would only have to pay $10 to do it. So again, $385 went into our account to sell it. Now it'd only be $10 to close it out. And you might be wondering in this case, well, why would you be interested in actually buying it back? I mean, you still have $10, right? And the reason that you might be interested is that there could be, even though, Meta in this case went crazy high, that was a stock specific event that led to this higher. And again, this hypothetical example, you very likely could find, or, I could find another stock out there where we could actually repeat this process. And so essentially from October 7th until 10/21, you would be tying up $13,500 to make $10 over 2 weeks. One of the ways that I like to think about how I could do that is, well, if I do 10 times 26, right, because it's for every 2 weeks, that's $260. That $260 divided by the 13,500 cash we had to put out there gives us an annualized return of 2%, which really at that point in time, I mean, that's really the same run rate of a savings account, right? So do I think that we can find a better investment out there that's going to do better than a savings account? I do. So again, I would actually be wanting to close this out in this example. Well, what happens in that case, right? Well, now we just had to pay $10. So that's going to come out of our cash balance. So now in this case, our cash balance becomes the actual new account value, right? So that would get us to this point. But, and in a lot of cases, again, if you're going to end up buying them back, the account value, is a pretty reliable indicator of how the account's doing. Let's think about this though on a different way. Okay. So let's say that we got this 385 premium. Now let's change it to the stock doesn't go up. Let's say that Zuckerberg says, hey, I'm never retiring. I'm going to, I've figured out immortality for myself, and I'm going to run this company from the metaverse for the rest of my existence that will be never ending, because immortal definitions and stuff. So let's say that on that news, everybody says, man, we can't get rid of Zuckerberg. That's horrible. And the stock actually goes down to $140. What a deal. So the stock goes to $140 on the news that Zuckerberg, we're stuck with him forever. Not exactly a cratering event, but again, this is just for the sake of argument. You remember Meta right now closed at 146. Now they go down to 140. Well, in this particular case, what's going to happen to our premium? Our premium now, again, think about it. Just like when the stock moves up, that's actually going to lower the premium. As the stock goes down, that's going to increase the premium. So it was 385. Now that it goes down to 140, let's just say, that this actually spikes the premium up to $500. Okay. Well, if it goes up to $500, now we actually got paid $385. Now it's $500. So now we actually have this negative equity. We've lost $115, but this $115 we lost, you'll notice still hasn't actually changed our cash balance. It's only changed the account value. And that account value only really matters if you want to cash this out. Again, for example, if the stock goes down and we can say, okay, it's going to cost us $500 to buy this back. Yes, we got the 385. That would leave us 115 in the hole for doing so. But you could also say we still have $5 where this stock would have to fall before we would have to do anything. Okay. So what does that mean? That means, let's just say that now it's 10.7 and, Meta's at 140. Let's say we go through time and now, we get to 10.14, another week goes by and they're even lower. Let's say they go down to like 138. Well, now again, other things equal, as we move through time, the value of the option is going to decrease, but then other things equal for the same time, as the price goes down, the value of that option is going to be more expensive to buy back. So we kind of have two variables in play now. We're moving through time and we're also moving the price. But hey, that's how the actual market works. We're always moving through time and moving through price when the market's open. So still useful to think about. Let's say, again, the stock actually goes in that next week from 10.7 to 10.14. They go from 140 to 138. So continuing to go lower. And let's even say, for the sake of argument, that our premium is actually even more going to cost even more to buy back on that option. So now it's going to cost us $515, which would leave us $130 in the hole after the original $385 that we got. But you'll once again notice, yes, our account balance is actually now going to show that we are $130 lower, which is all stemming from that increase in the option because Meta stock is lower. But what else is true? We still have that 13,885. Let's say that the stock actually stabilizes at around the 138 or in the mid 130s. Another week goes by. This actually expires worthless. And this becomes your account balance. In that case, becomes your cash balance. You got to keep that entire 385. You didn't end up having to buy the stock. So there you go. Now your cash is the account balance. Now, the third and kind of final example here, let's think about what happens if Meta, and let's get rid of this yellow, Meta goes to 130 by 1021. Let's think about this, right? So it's not all sunshine and rainbows. The stock isn't always just going to go higher when you sell an option. And it's not always going to stay above your strike price. Sometimes it's going to fall low, and you're going to get assigned. You're going to have those shares put onto you. So Meta goes down to 130. And in this particular case, even though it's at 130, we had to pay still the 135. There's a contract, right? It's enforceable. That's what the brokers are there for. You can't change your mind after you sell it. You can buy it back, but you can't change your mind and say I didn't sell it. So how does this shake out? You're going to buy 100 shares of Meta, and you're going to buy them at a price point of $135. So stock price and then stock quantity. And again, remember, it's 100 by default because it's just 100 for every options contract that you sell. Oop. Gonna undo that. We're gonna do this. Multiply those out. So we had to pay $13,500, but what's actually in the account is this 130. So what's our actual account balance in this particular case? Well, it's 13,000, but what else do we have to take into account? We did get this premium, so we now had to pay $13,500. Now we only got 13,000, worth of shares, but we had to pay the 13,500. That's gone. That's true. But we still do have this premium. So our premium cash in this case was the 385. So now we can really think about like our new account worth of being, we take our cash, take our 385, take the market value of our equity, and now this is what I would call how much of our account is actually worth. Now, again, what's it going to show your cash balance in this case is, right? It's going to show cash balance is 385. It's going to show account balance is actually going to be this 385 plus the 13,000. That's our account balance. And then the other thing, of course, that we would be able to do in this particular point would be we own 100 shares of stock. We could actually now turn around and sell a call against this, and we can actually sell the call, you can really pick any price you want to, but one of the useful things you can kind of think about is, okay, well, if you had to buy it for 135, it's down to 130. Wouldn't it be interesting to say, how much would it cost for you to be able to sell a call on Meta for $135? Because now if somebody buys them for the 135, well, you paid 135. Now somebody's going to buy them from you for 185 or 135 rather. You got paid the 385 in premium. Now somebody's going to pay you for the call. So you're going to get paid to buy them, paid to sell them. The purchase price and the sale price cancel out. You're left with the premium you got to buy them. And what we haven't talked about down here yet is the premium you would get to actually sell them. And let's just say in this example, it'd be pretty close. Let's say, the value or the call premium to sell at 135 meta a month from 10/21 when you actually had to take ownership. Okay, let's say that call premium was $200. Well, what are we now left with? In that case, we got put premium. We got put premium of 385. We got call premium of 200. What's our total premium? Our total premium is actually now 585. And that's an interesting number, right? Because at that total premium, we can take that number, we can divide that by 100 to get it on a per share, and we can see that too low. So this 585 is our total premium received. 585. Well, again, how much did we have to pay for Meta? We paid 135. So let's take our 135, but we received $5.85 per share for the put and the call together. So our break even is actually 129.15, and the stock is currently 130. So that's another way we can kind of think about this. And that's useful because what happens if, that another month goes by? Let's say that we're, middle to end of November and Meta happens to be still at 130, or maybe they're down to 125. Well, again, if they're down to 125, you're not really out the difference between the 125 and the 135. You're really out the difference between 125 and 29. And in that case, you could say, well, it's still not great to be out anything. But let's remember, this whole transaction started when Meta was at 146. And instead of actually just selling that put, if you would have just straight up bought the stock, you would have been down, the 125 minus the 46 as opposed to the 125 compared to the 129. So, to me, following this approach allows me to have a little bit more protection to the downside while still having opportunity to get compensated pretty well, for the risk I'm taking on. But the main point of this was to just walk through some different scenarios of, again, what's going to happen to the cash balance, the account value, after you sell a cash secured put, in different scenarios when the stock's going to go up, when it's going to go down, when you're going to get assigned. I think every time I go to explain this, I feel like it feels very straightforward and pretty easy. And then I get talking and showing all the math, and I feel like I'm kind of reminded that there is a little complexity to this. So if you have any questions, let me know in the comments below what made sense, what you still need to maybe get a little bit more clarity on. Would love to hear from you. Thanks so much for watching, and see you next time.